Are you just like the rest of the world who's all holding some form of the S&P 500 in their investment portfolios? Well, you should stop investing in the S&P 500, and I'll tell you why. Can you beat the S&P 500 returns over the long term with the same or lower risk? You bet you can. So why do most people, including financial advisors, use an S&P 500-based exchange-traded fund or mutual fund as a core component in portfolio allocation? I'm going to show you why there are better index-based investments that will provide better returns over the long term with about the same maximum loss as the S&P 500. Sound too good to be true? Watch the rest of this video to find out. So let's cut right to the chase. Let's take a look at how the S&P 500 performed over a 15-year period and even over the last 5 years versus how the NASDAQ 100 performed. I think this will tell you something. So here's the S&P 500 in the darker blue line, and here is the NASDAQ 100 in the lighter blue line. And you can see just over the past 5 years that the NASDAQ, while it has been a little bit more volatile, has handily outperformed the S&P 500. In fact, the return is just about double, 97% versus 54%. This is a huge difference. And let's look back over a 15-year period. Don't get confused by this graph. It's really easy. This axis here, the vertical axis, is return, so bigger is better, obviously. And the horizontal axis is the maximum loss you would have incurred back in 2008, 2009. You can see for the S&P 500, it was about 55%. And for the NASDAQ 100, the maximum loss was about 53%, so not quite as bad. But look at the difference in returns. The S&P 500 had a 10.41% compound annual rate of return over that 15 years, and the NASDAQ 100 had a 16.77% compound annual rate of return over that same 15-year period. That's a big difference. So why does a less diverse index like the NASDAQ 100 with only 100 components beat the S&P 500 with 500 components over the long term? More is better, right? So shouldn't 500 stocks beat 100? I'll give you the simple answer here. But if you want to dig into the details, please watch my video titled, Why Most Money Managers and Retail Investors Will Never Beat the S&P 500. Link in the pinned comments below and at the end of this video. Well, it really comes down to two reasons. One is obvious and the other is a little more subtle. So let's look at the first reason. Reason one, the S&P 500 is more diversified than the NASDAQ 100. So the S&P 500 holds a much wider sector exposure than the NASDAQ 100. As I've discussed many times in my previous videos, more diversification becomes counterproductive at some point and causes lower returns and worse maximum losses. So what's the second reason? Well, both the S&P 500 and NASDAQ 100 are market capitalization or market cap weighted. Wait a minute, huh? Well, okay, so what this means is that each stock in the S&P 500 and in the NASDAQ 100 takes up an amount of space proportional to its market capitalization. So a bigger market cap company like Apple or Amazon or Microsoft will take up more room in the index than a smaller cap-weighted stock like Coinbase, if it's in there. So anyway, so why does this matter? Well, because there are 500 stocks in the S&P 500 and 100 stocks in the NASDAQ 100, the largest allocations in the S&P 500 will be much smaller than the largest allocations in the NASDAQ 100. Let's take a look at this so you can get a sense of what I'm talking about here. So here's a spreadsheet showing the components of the S&P 500 over here on the left and the components of the NASDAQ 100 over here on the right. And you can see that Apple makes up about 7% of the S&P 500, Microsoft about 6%, then it drops off really quickly. Amazon's 2.68%, NVIDIA 1.99%, and so on. You can see how quickly we get below 1% here. So any one of these companies can't really do much to the index except for Apple and Microsoft. The rest of them, really don't have a lot of impact, even if they change by a large amount. So if we look at the NASDAQ 100, Microsoft is weighted at over 12%, as you can see here. Apple over 12%. Amazon 6%, Nvidia 5%, and so on. And we have to get pretty far down the list here before we get below 1%. So why does this affect performance? Well, I bet this isn't obvious. But again, if you want the details and the proof, watch my video, Why Most Money Managers and Retail Investors Will Never Beat the S&P 500. But it really comes down to this. If you hold many stocks in your portfolio, there will only be a small number of big winners over the long term. Obvious, right? I mean, look, how many Apples, Microsofts, Nvidias, Teslas, Amazons, and Google companies are out there? Not that many, right? So look, to the extent those large winners are handcuffed by only being allowed to become a small portion of your portfolio, that portfolio will underperform a portfolio where the best performers are allowed to grow to a larger portion of the portfolio. Wow, that was a mouthful. So what the heck do you mean by that, Calvin? Well, it's actually simpler than it sounds. Look, because the S&P 500 has 500 stocks in it, the biggest winners must compete with the other 499 stocks for elbow room at the top. As I showed you earlier, this inherently causes Apple and Microsoft to only be 6 or 7% of the S&P 500, while in the smaller NASDAQ 100, they account for over 12% each, as I showed you earlier. But let me demonstrate this quickly another way. Here's a portfolio of 6 stocks, just to keep things simple, okay? This model allows me to artificially restrict each stock position or let it grow to its full potential. So in this example, just for demonstration purposes here, I'm not trying to prove I can pick a portfolio that's going to outperform or do better, because obviously I'm using future knowledge here. But look, we've got a portfolio here of 6 stocks and 4% cash. And if I handicap this portfolio by only allowing any one of these positions, including cash, by the way, to never become more than 20% of the portfolio, you can see that I get about a 10% return here, which sounds great, right? And I get about a 45, almost 46% maximum loss. And you can see up here that none of these positions ever got to be much more than 20%, as they shouldn't, because I've forced them not to be. But what if I let these grow a little bit more? So let's let them grow to 40% instead of 20%. Well, what happened to my return? Well, my return went up, and my maximum loss actually got a little better. Okay, what if we let them grow to 60%? Well, now my return went up a lot more, but my maximum loss got worse. So there's a trade-off there that you have to play. But let's take it even further. And then what if I just let them run wild? Okay, at 100%, we get the highest return here, and our maximum loss is already maxed out at minus 54%. So you can see by limiting the size of any one of these companies in my portfolio, I limit my ability to generate better returns. So if, as I've shown, the NASDAQ 100 has much better performance than the S&P 500, why does the S&P 500 ETF SPY have more than double the assets of the NASDAQ 100 ETF QQQ, as you can see here in these numbers? So the S&P 500 has almost 360 billion in assets under management, while the NASDAQ 100 has 157 billion, let's call it, in assets under management. So why would this happen when you can get better long-term performance with the NASDAQ 100? And why do most investors, financial advisors, and money managers fall into this trap by leaning so heavily on the S&P 500? Well, here's what Warren Buffett has to say about it.
We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. There is no value added.
Now, this is where I might get a little bit dark, but could it be that the advice to diversify your holdings serves someone else's best interest and not yours? Or maybe it's just plain ignorance and a lack of investment understanding and skill. If you're managing your own portfolio, be smarter about how you use diversification and make it work for you instead of against you. Or in other words, invest smarter. I just had to get that in there. Look, you'll find better suggested allocations in the videos linked in the pinned comments below or at the end of this video. I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.